John Jenkinson here with you on the Market Day Report to go over some more of these harvest numbers that we had out from National Ag Statistics yesterday afternoon. We'll start over here in the cotton harvest where Texas says that they're 42% complete now. The 5-year average is at 38%. Georgia 67%. Louisiana 90%. They're only 5 points behind where they usually are this time of year. Alabama 71% and North Carolina 58%. As far as the sorghum harvest or milo is concerned, Texas is completely done according to the latest numbers. The 5-year average is 83%, so Texas sorghum harvest really got kicked into high gear. Oklahoma 69%, Arkansas also at 69%. South Dakota's got 47% of their milo in the bin, and Nebraska 54%. Peanut harvest for Georgia, 89% complete. That's ahead of the 5-year. Alabama's also ahead by 9 points. Florida, they're ahead, 97% wrapped up there. North Carolina and South Carolina are also ahead of the 5-year average. So those crops faring pretty well. Just waiting to get the rest of the soybeans and the corn out of the field now in some of these cases. Speaking of corn, let's look at the market right here. We've gotten all the way down within a half a penny earlier of hitting the 380 threshold, and now we're just down a penny from the overnight and the day trade. 382 1/4 is where we're at. The July is down 1.5 at 405. So let's check in with Brian Hoops, Midwest Marketing Solutions in Springfield, Missouri. Brian, this performance here of the corn market today, it got down there pretty close to 380 and seems to have backed away from that. Why the lift? Is it just some concerns that maybe some of this corn harvest may not get done in a timely fashion, or is it maybe some uncertainty about what's in this next report out on Friday?
Yeah, it's probably a combination of both, John. We are hearing, a lot of concerns about the remaining harvest of the crop. A lot of the crop that's been harvested was in good ground and on moisture levels that were, pretty adequate to sustain machinery. The remaining next couple weeks could give us an opportunity to harvest that crop, but it's going to be difficult because of the ground and the situation that we're in. But, there should be a reason to see a little bit of a market rally, I think, going into Friday's report. There's a lot of uncertainty and a lot of hope that the USDA will lower corn and soybean yields. The average guesses going into the report suggest that you'll see a small reduction in yields. And I think we're going to need to see a pretty large reduction if we're going to sustain any type of upward momentum in this corn market. This morning we fell to the lowest levels in about 3 weeks, and before we found a little bit of buying interest in here. But with our demand trends as slow as they are, as evidenced by yesterday's inspections report, we're 62% behind our normal pace for this time of year and last year's numbers. So there's real possibility USDA decreases our export profile on Friday, and that would increase our ending stocks unless we get that big cut in production.
Ryan, you mentioned those soybeans. Right now, the November down 3 3/4, 922, and that's 2 pennies off of the low. The January is down 3.5. Over the wheat market, we're about 1.5 pennies higher on the December, and the July Chicago wheat is actually down 1/4. Kansas City wheat, we're up 2 on the December, but again, July steady at 453. Is there anything that the market will be watching for? We talk a lot about soybeans and corn. What about wheat in this world supply demand?
We're watching the world numbers probably as close as what they will for the U.S. numbers. It was just announced here this morning, just a few minutes ago, that Egypt ended up buying 175,000 metric tons of wheat off of the world market, which is a step in the right direction, but the U.S. was not included in any of those purchases. And so our demand profile, remains above last year, but just barely. It was a second worst week of our marketing year in yesterday's report. So there's nothing outstanding about our exports. And as we get into this time of year, wheat's starting to go into dormancy in a few weeks. We're at a much higher good to excellent rating than what we were a year ago. And that doesn't always portend to yields, but it does give traders confidence that at least we're off to a good start.
That's a good point, Brian. All right, we'll be back in just a moment. Right after the break, we'll get you the latest numbers from the trade on livestock next here on the Market Day Report. Brian Hoops and I were just talking off air about this next show list. I haven't had a chance to look it over yet. What's it show, Brian?
Yeah, it does show us a little bit larger than what we were a week ago, 270,000 head. That's 7,000 more than last week and quite a bit more than year ago levels, over 30,000 head more than last year at this time. But, the Packers have increased their slaughter levels. They have profit margins just really, really strong for them. And with those strong profit margins, cutout values continue to move higher, and that keeps their margins very strong. And so they're going to keep increasing weekly slaughter levels. We were above a year ago levels last week. And as long as we do that, there should be a strong demand for the cash cattle market.
Exactly right, which you would think would lead to another higher trend over here in the cash cattle, which could lend more support to the futures side. Has the trade been impressed with the resiliency of the capacity to be able to slaughter numbers like these with that Tyson Holcomb plant still offline?
Yeah, I think it certainly has to be. We've had such a strong rally, and that's a major contributing factor is we are able to absorb that facility. That's about a 6,000 head a week kill facility being offline just by increasing our weekend hours. And so if we can continue to do this, and if that plant does open, it should increase the packer demand even more. But key will be maintaining profitable margins. Is
there the concern that once that plant reopens that maybe the profit of some of these other plants will back off a little bit and that'll soften this cash market?
Well, that's the fear. They've been running so hard on weekends and increasing some of these other plant hours that they'll start backing those hours off and giving some of those hours back to the facility when it reopens. And so that's a very likely scenario. And if that happens, you may see the weekly slaughter levels back off a little bit, but with these strong profit margins, I don't think we're unlikely to really slow things down very quickly.
Okay, over in the live cattle market, we talked about that little bit of a pullback, 95 cents worth of that, 119.13 on the December, the February down 70. Feeder cattle down 130 on the November, January down 68 at 145.32. But Brian, look at this hog market go here today. December up $1.77, February up $1.30.
Yeah, we finally need some good news in this hog market. It's been a long time coming. We've had some consolidation days here the last couple of trading sessions in most of the markets. That's usually an indication, markets consolidating, then going to have a big move, and I guess we're seeing it to the upside in the hog market today.
Especially on these front month contracts where we still have quite a bit of spread between the front months and the deferreds.
Exactly. Yeah, we have a huge spread, and that spread's probably going to be maintained. We're having a kind of a correction in some of those spreads, but without an agreement with China on the horizon, December is going to really struggle, I think, on rallies.
Brian, always good to visit with you. Brian Hoops here with us, Midwest Market Solutions in Springfield.
All right, good update.